The 1970s were a pivotal decade for the efficient market hypothesis, EMH, serving both as the period of its formal dominance and the era when the first cracks began to appear. The decade opened with a landmark event. Economist Eugene Fama formally defined and synthesized the EMH in his influential 1970 paper, Efficient Capital Markets, a review of theory and empirical work. This work provided a clear framework, categorizing market efficiency into weak, semi-strong, and strong forms, which became the dominant paradigm in financial economics throughout the early 1970s. During this time, the EMH was widely accepted, suggesting that stock prices fully reflect all available information, making consistent outperformance impossible. However, paradoxically, the foundation for challenging this hypothesis was also being laid. Researchers began publishing empirical evidence of stock market anomalies, persistent patterns that contradicted the EMH. A key example is the first robust documentation of the January effect by Roseff and Kinney in 1976, which showed that stock returns in January were significantly higher than in other months. Other anomalies, such as the tendency for baskets of low price-to-earnings, P/E, stocks to outperform, also began to emerge in the academic literature. These early findings created attention. While the EMH reigned as the theoretical benchmark, the discovery of anomalies in the 1970s provided the first empirical puzzles that would eventually fuel the rise of behavioral finance in the following decades.